Today we're very happy to have Bill Buettin as our speaker for a look at the financial side of historic preservation. This has been a difficult part of a project for many people, and it's crucial to project success. So we're very happy to have him here to speak to us. Bill Buettin is United Bank president of the Northern Shenandoah Valley, which includes the city of Winchester and Frederick, Warren, and Shenandoah counties. His entire career has been in banking, and his expertise is in commercial real estate finance. Prior to moving to Winchester in 2009, Bill was the vice president of investment real estate at a regional bank in downtown Pittsburgh. He now lives on South Stewart Street in Winchester with his wife and 2 children. In addition to serving on the Preservation of the Historic Winchester Board, he is also a board member of the Winchester Economic Development Authority, on the Manhattan School Board of Trustees, on the Development Cabinet member of Winchester Medical Center Foundation, and is a member of the Winchester Rotary Club. So please welcome Bill Buettin.
Thank you. Appreciate that. Folks, some of what I have is related to, my background really is mostly in investment real estate, buying and selling properties for income. So I'll touch a little bit on that. I can keep a lot of time left for the end to touch on things like how do you do it? How does a nonprofit finance something, or how do you get lower interest loans for community benefit type projects? So with that, I'll get into this a little bit. And excuse me, I got to hit this thing. So what I'm going to try to not do is bore you. I mean, PowerPoint tends to be a little bit boring, and so I've got some cartoons in here. And I think the best thing is to not wait until the end to ask questions. If you have something that you want me to touch on the slide, or you don't understand what I'm saying, or you just want to ask a question, just go ahead. I mean, we'll definitely leave some time for questions at the end also. So here's just kind of what I thought I would go through. Financing historic properties is not that much different than financing regular properties in terms of how you do the financing. There is obviously a lot of other things that go into historic properties, especially when you're in a historic district, or you're looking for tax credits that aren't specifically related to the financing, unless of course you're looking to syndicate the tax credits to provide equity. So I'll go over some of the basics of financing that, again, some of this might be too basic and some of it will be beneficial. Do some financial analysis of real estate to say, what is a good deal, what's not a good deal, how do you look at properties. I thought it would be interesting because I have a lot of background in Taylor Hotel project. We finance it, United Bank financed it. I'm also on the Economic Development Authority of the City of Winchester, so we're a 50% partner in that property, and it's a public, a lot of information was public, although didn't get widely distributed, so I thought I could go through some of the data with you that might help understand how complicated a project that is, and give you some insight into how that was structured. And then I'll touch a little bit on what's going on in the interest rate environment. I'm not an economist, so I don't have a background in that, but I can give you some reading of the tea leaves and things like that of what's going on in the interest rate market. So financing basics. Here's another little cartoon. Okay, folks, let's move along. I'm sure you've all seen someone qualify for a loan before. And this is kind of how it felt for a few years, certainly from the downturn, which started in late 07, really hit in 08. Technically we came out of it in 2010, although, I still felt bad about things even, through the beginning of last year. And certainly the banks had a big part in that downturn. We like to think that was the big banks and not the smaller community banks, but we all sort of got painted with that brush. And there were times where it was very difficult to get financing for any project or even your home. And so I would argue that that's changed, and over the last, I would say, year or so, it's become we've kind of got forgotten a lot of the mistakes that we made during the heyday, and banks are back to some of their old ways. You know, what happened is basically the Federal Reserve and others pumped a ton of money into the banks. The banks got very conservative, and I've got my things. Banks got very conservative, so they built up a tremendous amount of cash on their balance sheets, and that cash doesn't earn any money. We all have shareholders that require us to make more money every quarter, so we're out trying to find loans aggressively these days, and so is everybody else. And when that happens, what tends to go first is the interest rates, and then what happens second is the deal structures tend to go back to where it doesn't make as much sense to us, at least, as it did before. Now, we've been pretty consistent throughout. We didn't make a tremendous amount of bad loans during the run-up, so we didn't stop making loans during the downturn. But we just kind of plug along with what we're doing. But it has changed, I think, back to being in the borrower's favor. So the question I get asked most often, particularly from folks who we don't have a relationship with, is what are you looking for from me and my business if I want to borrow money? And so that's a real general question, but it basically boils down to what am I supposed to bring you so that you can underwrite my loan? And this is a pretty general list, and I can get this to Ed if anybody wants it, but it's pretty standard, and it looks daunting because it's a lot of bullet points. But basically, ask me. I want to know generally what you're going to use the money for. So some doesn't have to be very elaborate, but some statement that shows, hey, I'm going to borrow this money to renovate XYZ property, and here's some background on that. Personal financial information, personal tax returns, and then if you have, a lot of real estate deals are done within companies, either LLCs or corporations. So getting some financial information on the company, historic typically, and then if you're doing a project that requires renovation, and we call that it's not stabilized yet, we look at the projections of the deal, what do you think it's going to earn you over the next couple of years. And then real estate stuff, if you're buying a property, give us a copy of the purchase agreement. If there's a survey, it shows us what it looks like. A budget to show me what you're going to be doing with your money. Some plans and specs, and if there are tenants, tenant information and lease information. And then if it's an operating property that you're buying that has a historic cash flow, show us what the income and expenses have been historically for the past 3 years, if that's applicable. And this is, I have a bunch of little things in here that we can go through in more detail if anybody wants, but this is basically just a boilerplate whole section of a personal financial statement. It's just to give you an idea of the information that we look for, which basically breaks down to, on a personal level, what you have asset-wise, cash and real estate, stocks and bonds, and other assets, and what debts you owe on the liability side. And so that's just a standard form that we have, and all banks have. This is a standard rent roll form. If anybody's not familiar with this, basically shows you what who your tenant is, what their lease rates are, how many square feet they lease. It also would include vacancies and any options. Say they have a 5-year option for renewal that renews at X rate, or if they pay a certain amount of expenses. So that's just a standard rent roll. And then this is that form where I talked about 3 years of historical numbers. This basically runs through what historical cash flow would look like. And this sort of template, or these categories, are used basically throughout real estate finance, regardless of what type of property you're looking at. So rental income being gross rents that you receive from your property, and then factoring in some vacancy to get your effective gross rent, looking at all your operating expenses to get to your net operating income. And we'll go through a little bit more in detail when we get to the next section. So this is a lot of text, and I don't expect you to read it, but basically when you give me all your information, what are we looking at to make a credit decision? You provide me with this giant stack of stuff, and I have to now take that stuff and make a decision about whether we should lend you the money, or under what terms and conditions we should lend you the money. And so this dates back. I've been following the 5 C's of credit since I've got into banking. I think it's been around for a couple generations. It's pretty basic stuff, but it's still what we all follow as far as making credit decisions. Character is by far the top credit decision that we all, characteristic that we all use when we're making loan decisions. And that basically is, you know, who are you? Who do we know that knows you? What do you do in terms of when things get difficult? How do you treat others? Basically, you know, if things get tough, we want to know that we have somebody there to work with that's going to stand by with their obligations, who's going to communicate with us, and you know, who essentially is in this as a partner with us. Capacity, in a lot of ways, just basically is cash flow. It looks at how much income is being generated by what you're looking to finance, how much can you borrow as it relates to that cash flow, and so capacity to borrow, how much money can you actually withstand within that asset that you're pledging as collateral. Within that, there's a bunch of benchmarks that we look at, debt service coverage, there's liquidity measures. It really depends on what it is that we're financing. Capital is really relates to you or your company as a whole, basically saying what if you don't hit your cash flow capacity projections, what else is out there to help you withstand a downturn. So that a lot of that has to do with what net worth is behind you, what cash resources do you have at your disposal, and you know, there's a buffer between this project's not working and the bank has to come in and take corrective action. So it gives you it's basically what's your buffer. Conditions are important, and conditions change over time, and we certainly look at that. That's, you know, what's the macro environment look like for whatever you're trying to do? Is there a market demand for a new office building or historic renovation of a property on the Old Town Walking Mall? Is there a demand for apartments? What do we see going out in the future? What do the demographic trends look like? It just basically, will the market accept what it is that you're trying to do? And collateral is our least favorite option because when we're looking at collateral, we're our primary source of repayment, which is what your cash flow or whatever personal or business resources you bring. We've expended those, and now we're looking at how do we get repaid from the collateral, meaning through the sale of the asset. So it's important. It's basically our third source of repayment after the cash flow of the property, or cash flow of your business, I should say, and then what other resources that you have to bring to the table. That's sort of the last, our last resort as far as getting repaid. And so those are some basics of just sort of how we look at it. So here's some other factors that we look at when we're looking at rental real estate loans. If you're buying a property that has tenants and is existing, then we look at the history of the leasing, and who's been in there, how long have they been in there, what rates are they paying, how those rates relate to the market, and future leasing. If you have tenants in there, what's their expiration date on leases, what are the likelihood that they're going to renew, or if they don't renew, who will come in to backfill that space. Debt service coverage is, and I'll go into that calculation a little bit more in detail, but how much cash flow is available to cover your debt payment now, and how much is it when you borrow this, or this proposed loan that you're applying for is approved. If it's a property that's existing, we're going to look at the physical needs of the property. Essentially, have you been keeping up with the maintenance of the property? Does it need a new roof? Does it need new HVAC? Or have you taken care of all those things over time? Because those are uses of cash and cash flow that, in addition to debt and normal operating expenses, we have to figure into our analysis. And then the current loan to value, based on the current cash flow of the property, the market rate for a market cap rate, which I'll go into. What is the value of the property today? And I should say stabilized and unstabilized. Stabilized property just basically means that it's in existence, it's been in existence for some time, and it's where you expect it to be as far as rents and in expenses. Unstabilized properties are properties that are in redevelopment or under construction that you don't have a history of cash flows, and it has to ramp up essentially to where you expect it to be on a pro forma basis. And so on unstabilized properties, we're really looking at projections. You know, you're going to renovate XYZ building. It's going to have 5 apartments. It's going to have commercial space down below. What are you going to get for your apartments? What are you going to get for that commercial space? And what do you project your expenses to be? And we have to test those. You know, are those accurate? Do we look at some other market information to say, is that in line with what we have on other properties? And if they don't hit those pro forma assumptions, what does that do to the cash flow and the loan value and things of those magnitude? Likelihood of hitting leasing targets, again, is somewhat of a pro forma assumption, but that also has to do with there's cost that you incur between the point where you start construction and the point where you hit stabilization. A lot of that is, you know, debt service, paying taxes, expenses that you have that you need to cover without having the rental income. And so if your leases don't hit, if they're 6 months behind where you expect or a year behind where you expect, you have enough built into your budget so that you can reach those targets. Again, debt service coverage now, how much cash is being generated today to cover debt, and that has to do with how we structure the debt and how will it look at stabilization. And as I mentioned, the total cost to reach stabilization are not just project costs, but carry costs, which are your interest, your taxes, other than your construction budget costs that you'll incur to maintain the property throughout the lease up and construction period. Okay, so financial analysis really has to do with how do you look at properties, and not so much your banker, although you know you should probably try to wear your banker's hat when you're looking at properties. Although I would submit that wearing your banker's hat for too long is a dangerous proposition, because you wouldn't want to live in the head of a banker for too long. So this is another cartoon. Good news is I see you selling many houses. The bad news is that you're playing Monopoly. Okay, so the 2 most important questions to ask yourself when you're looking at buying property. The first is, you know, what is the property worth now, and what would it be worth in the future, and how much would I need to borrow, and how much money will I have left over after I make my payments each month. And so there's a couple ways to look at that. First is the value of the property. This is appraisal jargon a little bit. When you do a commercial appraisal, they'll look at it in 3 ways. They'll look at the cost approach, the sales approach, and the income approach to value. And they'll come up with one synthesized value of all 3. In a lot of projects, particularly historic renovation projects, they don't look at the cost approach, because the cost approach is basically what would it cost you to build this property from scratch, and then taking away some of the depreciation of what its current condition is. And so if you've got a building that was built in the 1840s, the cost to build that really isn't applicable today, because the cost is much higher than the market value typically. And so cost approach will really come in typically when you're building a brand new property, a brand new apartment building or strip center or office building, to say if somebody else had to build a brand new office building, what would it cost them? The sales comparison approach is probably what most people think of when they buy and sell real estate. What are others buying and selling real estate for? And so that's looking at comparable properties of size, location, physical characteristics, and in investment real estate, also income and things like that. What are others willing to pay for that? And so if you're an investor looking at a property and wanting to look at the sales comp approach, some of that is publicly available data you can get on, LoopNet or CoStar or Zillow or websites like that can show you some sales history. But you also, if you're working with a broker, such as Oakcrest Commercial, you would be asking them what are some comparable properties that have sold recently to get some idea. But in most cases, and this is the one we lean on a lot as bankers, and if you're buying an investment property, I certainly would recommend leaning on the income capitalization approach, because a lot of that drives, particularly in a market where you've got a steady stream of buyers and sellers who are educated about investing in real estate, the sales comp approach will really, a lot of that will be driven by the income approach. And so basically, you're looking at what's the income being generated from the property today and in the future, and what rate of return would I be required to get in order to make that investment worthwhile for me. And so this is an example of how you come up with the income approach to value. This is a vanilla 14-unit apartment building that it leases for $900 a month, 12 months worth of income. And whether you have a vacancy or not, it's always important to include a vacancy, because the market, even if you're 100% occupied, there's times where tenants are moving out. You also want to just project that there's going to be some vacancy. And appraisers are typically using 5 to 10%, depending on the property. And then you look at all of your expenses for that property, and the last two expenses, management and reserves, typically you as a property owner aren't going to necessarily put that into your budget, because a lot of times you're managing it yourself, and you're either doing it because you're looking at the bottom line and saying, I'm going to make $79,000 at the end of the day, and that's my management, or you do have a company and you bill it outside of that. But an investor is going to bake in a management fee, because you have to sort of assume that they're not going to manage it themselves because they're an investor. And so appraisers typically put in, that's pretty high, 10%, although for a residential property or multifamily property of 14 units, that might be more, that might be market. And then reserves is the concept of, okay, if you renovate the property or you buy it in this physical condition, over the time you own it, things are going to break. People are going to put holes in the wall. Carpet's going to need to be replaced. So instead of putting that in as a one-time item in year 6, you put a reserve in, and certainly we encourage you to fund that reserve annually, and put it in a savings account or a checking account, so that when the carpet needs replaced or when you got to replace the furnaces, you have that money set aside. So the reserves are typically in there. For a multifamily property, it could be $300 to $500 per unit. For an investment property, it could be 3% or 5% of the effective income. And so net operating income is really the most important number that you get to from a valuation perspective, and that's basically your income less your expenses, including the ones that aren't actual, like vacancy and management and replacement reserves. And then you get you have a cap rate. And so a cap rate, this is a very long definition of a cap rate, but a cap rate is basically at a given point in time, it's the rate of return you would generate based on the amount of money you're paying for the property and the income that it's generating. And so it's basically that net operating income divided by the price you're paying. And if you pay $900,000 for a property and you're generating $90,000 a year in net operating income, you're receiving a 10% return on your investment. And there's a tremendous amount of additional data and research on cap rates, and this is called a direct cap rate, which means that's what it is at that point in time. That doesn't factor in what your cash flow will do over time. If expenses go way up, or rents go way up, or you sell it in year 3, it's a static number, and so you can do things like discounting the cash flow. You can do a bunch of things with your cap rate, but you want to know what your cap rate is, and you also can do it in a different way, which is saying, I want a 10% return on my money, or I want a 9% return on my money. Here's how much the cash flow is. Do the math, and that's how much you'd be willing to pay for a property. So you can back into what you want to pay based on what cap rate you're willing to accept. And cap rates, in a market where there is a lot of sales, cap rates are a known number, and Winchester really doesn't have enough sales to have a real true cap rate, because there's not enough similar properties that sell. There's some exclusions to that, but in general, you're looking at regional or national cap rate data and sort of trying to figure out, well, how much more would an investor in Winchester want because they're not in Washington DC or they're not in Richmond. Although you certainly can look at what an apartment property sold for down, a few blocks away, or a shopping center sold for. But and a lot of times you're looking at larger pools of cap rates and then extrapolating down to your local market. Here are just some rules of thumb. I kind of went through those. Vacancy 5 to 10% is a good rule of thumb. Management fee of 5 to 10% is a good rule of thumb. Replacement reserves 3% or 300 to 500 a unit. And generally today we're seeing cap rates in the 8 to 10% range, depending on the property. Multifamily is the lowest cap rates today, it seems like, because multifamily market in Winchester, which is really just apartments, is pretty strong, and so you're seeing pretty low cap rates on that. And then others are just like triple net lease retail locations like the Walgreens or CVS. And as you go up, you kind of go up as the property becomes more specialized or more risky to get to what you're trying to do as far as value goes. This just shows two different scenarios for guessing a value or coming up with a value. This is an actual appraisal. Obviously it wasn't 1, 2, 3 memory lane, but it was from a traditional property. This is actually a historic property that was renovated, and you can see the difference between the appraiser's pro forma and the borrower's pro forma and how that affects value. This is basically a first floor commercial building with apartments above and behind the property. They had different estimates for some of the rental income numbers. The vacancy was slightly less on the borrower's pro forma, so you had $7,000 of less effective gross income than the borrower was projecting. And then on the expense side, the real estate taxes, really the borrower was right in this case, because a lot of people know downtown Winchester has a historic rehabilitation tax rebate. So in this case, the owners were eligible for that rebate, and so they really weren't paying $11,700 in taxes for the first 10 years. But then they included this appraiser included the repair reserve, professional fees, which is in addition to management, like paying your CPA or paying your financial advisor, and miscellaneous. So just not having to drive too far down into this thing, but the appraiser estimated the property was worth $1,050,000, and the borrower was expecting it to be worth almost $1.3 million. And it doesn't take a lot of change in your pro formas to get a big swing in value. Essentially there's some additional expenses, and the appraiser was assuming your rents were a little bit lower, and you've swung almost $250,000 worth of value one way or the other. Now, everybody in here who's bought property and borrowed money probably has horror stories from appraisers, and I have plenty of horror stories from appraisers. And in a lot of cases, they're not always right. But the way the banking regulation works, and federal government likes it this way, is there's an independent group of appraisers that the banks have absolutely no influence over. I can't talk as a loan officer or as somebody on the sales side, never get to talk to the appraiser. And so you're somewhat beholden to what that appraiser sees in the market. There's plenty of times where we've argued successfully that, in this case, like real estate taxes, or in some other cases where they just really missed something, and you're able to get them to change some of their value thinking on deals. But in a lot of cases, they're smarter than you are, and so they assign a value to the property, and that's ultimately what drives how much you can borrow. And so as the economy got tighter and property values started to shrink, appraisers and banking regulators started to really come down on appraisers and say, well, you guys were part of the problem here. You inflated values. You were basing them on projections that weren't realistic, and you were putting cap rates in there that nobody was willing to pay, except because you told them that they could pay that, they paid that. And so they took a lot of heat, and so then they became more conservative than they probably should have, because they wanted to say, well, you know, look at this, we're making these properties, we're valuing them much lower than we used to, and, you know, but I think they've come back a little bit, and the foreclosure market has slowed, so they're not using as many foreclosures as comps as they used to. So I feel, you know, I still don't like them, but they're getting better than what they were. So for renovation projects, which is kind of going along the lines of what we've been talking about, but you know, the first step is really to build a pro forma of what you think this property can generate from a cash flow perspective once you've reached stabilization, and that's what you expect this to generate on an annual basis once you're up and running and fully leased. Step two is to look at what's it going to cost you to get to stabilization. That includes the purchase price of the real estate, how much you're going to pay in closing costs, your soft costs, which are your engineer, your architect, your permit fees, and various other miscellaneous, you know, your appraiser, your environmental. Hard costs are basically what your bricks and sticks. What's it going to cost you to build out or build this property to what you want it to be? And a lot of that comes from your general contractor or your subcontractors, or you know, the number of bids that you get. Contingency always includes some contingency, because no project is done completely within its budget. I mean, there are projects that are within their budget, but most of them, there's a change order or something happens along the line where you need to use your contingency, and so a 10% contingency really is a good number. And interest carry, if you're borrowing the money on essentially a construction loan, you want to know how much it's going to cost you to pay that debt service every month while you're constructing the property. And so include that in your budget. And then marketing, you know, if you're going to pay a broker to lease your space, or if you're going to put ads on the internet that are going to cost you money, or in the paper, put all that stuff in there. And then test your assumptions. You know, try to be conservative when you do both of these things, but also test your assumptions. Say, if my rents are 10% less than what I thought, or if my costs are 10% higher, or my operating expenses are 10%, what's that going to do to my budget? Is this project still worth doing? And then once you do that, decide if that rate of return, you know, your cap rate is sufficient to do the deal, and then move forward or not. So solving for debt service coverage, this is what we do. I mean, this is basically for income producing real estate is our holy grail. I mean, we are looking at debt service coverage as a key determinant of whether we want to do a deal or not, as a sort of precursor to deciding all the other stuff, if all the other stuff works. So debt service coverage is basically that net operating income number that we talked about, which is your revenue and less your expenses, with all those other expenses in it, management fee, replacement reserve, vacancy, divided by what your annual principal and interest payments are going to be on your loan. And so that's basically how much coverage do you have within within your cash flow to pay your debt and then return some money to you, or as a buffer in case things don't, in case you have some blips in the road. We look at, for investment real estate, we look at 125 to 150 coverage. So in other words, for every dollar of debt you pay, we want you to generate $1.25 of cash from the income of the property, or $1.50. That number certainly changes based on what type of property you're doing, and whether it's owner-occupied or un-owner-occupied or investor-occupied. So if you're building it for your own business, some folks have a separate LLC who rents from the business, and they bake in some debt service coverage buffer, but a lot of them just break even or just barely, you know, put a little bit of buffer in there. So we're not looking at debt service coverage of 125 or 150 if you're doing your own property. We're basically, if you're a business that's building your own building, we're going to look at your net income, adding back depreciation and amortization interest, and say, does that cover your debt payment? So that's more along the line of, 1-to-1 than it is 125 or 150, because your purposes are different. You're not doing it to generate income, you're doing it to have a place to do business. And then test your debt service coverage under different scenarios. So again, that's stress testing for vacancy rates, rental rates, and expenses, and interest rates, and amortization. Okay, so this is probably going to be, I'm not going to go through it. This is probably a little bit more exciting for you guys, the Taylor Hotel project. So this says, okay, that's 5 votes in favor of saving the historical hotel and 1 vote for stomping it to bits and eating everyone inside. So, guess who said that? Okay, so this is the Taylor Hotel before, this most recently before it was constructed. These pictures are actually from the appraisal, but we all have seen pictures of how bad the Taylor Hotel looked before they started constructing the property. In this one, you can see sort of the front there is Loudon Street, and then it goes back to the mall, and there's nothing in between. And some of those are inside the building, but I mean, basically it was in very, very bad shape. And PHW knows that as well as anybody. So this is what the building will look like when it's done. And the question, and as you can see now, sort of they're building the balconies today, and within the next, I learned this morning, next week, they're going to close off the Indian Alley, or not the Indian Alley, the little walkway to Indian Alley to run the utilities under the ground. So the pavilion and stuff will start looking good. The front portion of this building, we need to have an occupancy permit by the end of December, so that we can get this into this calendar year historic tax credits. I would guess that some of the apartments will be done. I don't think the commercial space will be done by then. But this project will be fully completed certainly by early part of next year. So how do you go from that from the first slide to the second slide? There's a lot of factors that go into it, but the first is having a very good development team. A developer who knows what they're doing in this type of project is critical. You wouldn't want to do business on a deal of this complexity with somebody who just sort of cutting their teeth in this business. In this case, we did have a very good development partner in Winchester and Associates who did have done a number of buildings, but here locally they did the Our Health #2 building, which was the old Snap Foundry building on Cameron Street. The architect obviously is critical, particularly in a historic tax credit project where you really have to abide by what your plans are so that you can meet all your Part 2 approval and get your Part 3 approval so that you can actually get the tax credits. And then a general contractor who can execute on those plans. Again, getting the historic tax credits is crucial, and so following the plans exactly is critical. And then market support is, you could build the nicest building in the world, you could build this, but if nobody actually wants to be in there, it's a pretty bad idea to do it. And in this case, we hope and we believe that the market will support that property. There's been a tremendous demand for both the commercial and the apartments. The apartments are all fully leased. The commercial, we're working out the details of the final lease. And so that building will open, most likely 100% occupied. So we'll luckily, the market has supported that property. And then the last thing is to get from here to there is the creative financing. So I'm definitely not going to go through this, but this is how the deal structure looks like. All of these different entities are involved in how you finance a historic tax credit property like this. But it's not nearly as complicated as that flow chart looks, and I won't get into it, but there are a lot of components that have to be there to make it work. And I think, as I understood it, I think John Willingham came in spring and did a presentation on historic tax credits. So hopefully he's used this thing before, this diagram, and so hopefully was able to explain that. So I want to show you kind of how this property came into existence and how it works economically, and why it was sat there for many years vacant. without having a solid development plan. I think you'll see that when I go through the complexity of the numbers. So just physically, here's what the building will have when it's done. You'll have the original Taylor Hotel, which is that front building there. We'll have the English basement that is slightly subgrade. That's 2,500 square feet. You got the first floor, which is really where the steps go up, which is above grade and not at street level. You'll have the second floor, which is just over 2,000 leasable square feet. Third floor, same, and fourth floor, same. And the fly tower, which is in the back, the current plan only proposes to finish the first and second floor and have the upper floors of the Taylor Hotel be vacant for future development. I will say that, I think it was in the paper last month, but the EDA and the partnership are considering finishing out some of that, some of the fly tower, because there has been good demand and we are able to get tax credits for it if we try to do it now and fit it into the existing deal structure. Once you do the historic tax credit project, you really can't do a whole lot to the property for the first 5 years while you're in the tax credit compliance period. So the original proposal was to just mothball those upper floors and then 5 years later, when the historic tax credit compliance period ended, do something with them, because we really can't punch holes through the fly tower for windows or anything like that because of it being historic. And so, nobody's going to want to lease 4 brick walls without any natural light in there. So, but we are looking at it for the first 3 floors, which is essentially, you can barely see it, but the big opening in the fly tower that was left from where the old theater stage was can be glass, it can be windows, because there's nothing there now. So DHR doesn't require us to put bricks back up, so you can have a big open glass window there, which would look really good. And so that's what we're kind of talking about. But the fly tower, as it exists in the first phase, is 2,000 square feet on the first floor and 2,100 on the second floor. There's not a lot of units in there. I mean, even though it's a big project and a lot of building, there's not a tremendous amount of actual units within the building. So there's really 5 apartments. You can see this is kind of a second floor plan. There's just 1 apartment here and 1 apartment there and on the second floor, and then same with third and then the fourth floor.
Is that the fly tower or the front building?
This is the front building. So this is out here, and this is turned sideways, but it's basically, the elevator is on this back left corner facing the pavilion. So you have to flip it this way, and then so this is coming off the elevator. This is the hallway into the first apartment and second apartment, and then this is out onto the walking wall. So there's just 2 apartments in there, and so there's not a tremendous amount of building to get rental income from. So you've got what essentially look like this, and you're trying to generate enough income to make that economically viable using a very small number of units to get there.
When was the fly tower added?
Yes, ma'am?
When was the fly tower added?
When was it added? In terms of when was it built?
It's not part of the original building.
No, you know when it was added?
I'm thinking like 1910
Yeah.
possibly.
So what's standing there now is the original building? Even the metal section that's gone was not original?
Not original,
Not
but
original.
I mean, it was historic. It was just, and that was part of the challenge, was explaining and trying to tell Department of Historic Resources, which ultimately has a lot of say in this, that was just too far gone in order to be saved and preserved. And so the way the financing and the deal was structured, the city was allowed to demolish the centerpiece but retain the fly tower, which is tax credit eligible, and the original historic front. And so because it was 1910 and after 1950, it is tax credit eligible as long as you don't punch a bunch of holes in it and return it to basically a fly tower on the outside. Okay, so here's the economics of the apartments. Just kind of going along what we've talked about in terms of cash flow. Here's what they're expecting to get in rents on the apartments, and adding in a vacancy factor of 5%. Here's what the expenses are. The NOI, net operating income of the apartments, is $48,000 $352 per year. And then on the commercial side, you've got the Taylor first floor that they're projecting to lease at $14, the English basement at $10, and then the fly tower space, and the expenses for the commercial space as well. And CAM reimbursements is basically common area maintenance. What of the operating expenses will the commercial tenants pay and reimburse the landlord? This has a slightly higher vacancy of 6%, and so that generates an $84,000 net operating income. There are two other sources of income for the property that aren't commercial or apartments. The city of Winchester is paying $42,500 a year in essentially, the lease isn't the right term because that wasn't allowed. It's a management fee for the pavilion area, which the city will use for events. There'll be a farmer's market there. The new downtown manager and the events coordinator are already starting to work on planning for the next summer and fall planning for that space. So the city, that's the city's space. They're paying $42,500 for that until the debt is reduced to $600,000, and that helped fill part of this gap that you'll see in a second. And then Chantel has a cell tower on the fly tower, and they're paying $1,700 a month for the cell tower. So those are all the sources of income. You got the pavilion lease, the cell tower lease, the apartment net operating income, and the commercial net operating income. And so that's $195,000 in net operating income. And a cap rate in this case of 9%. So I said 8 to 10, this was a 9% cap rate. So the property has a value roughly of $2.1 or $2.2 million of value based on the income that it's generating. Here's the project budget, and you can see that the total costs are $5.2 million. So the question is, how do you make a project that costs $5.3 million but is valued at $2.2 million part? And the answer is, in part, creative financing. Okay, so the first tool that probably most relevant to what we're talking about here is the use of historic tax credits. The historic tax credit code allows you to take up to 20% of your eligible project costs and get a federal historic tax credit, and 25% of your state, 25% credit for state income tax. And so that's a total of 45% that a developer can get in historic tax credits. And in some cases, you use them for your own benefit. If you've got state and federal taxable income that you want to offset with tax credits, you use them for your own benefit. In a lot of larger historic tax credit projects, you syndicate them, which means an investor becomes the owner or the beneficiary of those tax credits. And how you syndicate state credits and federal credits is slightly different, but for this purpose, you sell them to an investor who takes the benefit of the tax credit, but you get the benefit of what they're paying for those tax credits. And so here's how the tax credit calculation works for the Taylor Hotel. This is the same budget you saw a minute ago, but on the right side are the costs that are eligible for the historic tax credits. Not all expenses are eligible for historic tax credits, but in this case, a lot of them were, including the development fee, which is a big part of historic tax credit deals, because you are able to take a development fee and get historic tax credits for that. So the eligible historic tax credits are $3.82 million. That generates a $957,000 state historic tax credit and a $765,000 federal historic tax credit. This kind of gives you an indication of what the market is for these tax credits. The state historic tax credit is sold for 83 cents on the dollar, so for every dollar of tax credit you paid 83 cents for them. So there's a return for the investor. Obviously they're not going to pay a dollar for a dollar of tax credits, but so there is some benefit to that. And then the federal historic tax credit investor paid 96 cents for their credits. I'll say that it's not actually 96 cents, but it's 96 cents on the face. This money here, HTC preferred return and put, comes back to the federal tax credit investor over the 5-year period. So if you add that into their return, they're really paying around 85 cents also. In this case, United Bank was also the tax credit, the federal tax credit investor, so I kind of got to see that side of the deal as well. The second piece of the financing structure, which was very unique to this project, and the city of Winchester's never done one of these before, is a HUD 108 loan. The city of Winchester gets on an annual basis an allocation of community development block grant money. That comes from the Department of Housing and Urban Development, or HUD. What HUD allows you to do on a case-by-case basis is borrow against your future allocations of community development block grant money to in today's dollars. So you pledge them to HUD. They loan you the money at a very, very low interest rate, and then you can use that money for the project. And it's basically like applying for a loan. They underwrite the project, but there's a lot, they're not looking at income, they're looking at the public benefit of that project. And HUD and CDBG money specifically looks at how does it serve low to moderate income individuals or communities or areas. And so in this case, the census tract that it sat in was low to moderate income, and the fact that it was a park that would be for public purpose also was met that criteria. So there's $1 million that went into the project. The city pledged its, not all of, but most of its 5 years of community development block grant money as essentially a grant into the project. And this is a little bit in the weeds, but the city had to essentially acquire the property and do part of the demolition and stabilization to use this money because part of the 108 loan allows you to eliminate blight as part of the use. So they segregated those funds out and used the $1 million to eliminate the blight that was existing. And then once they spent their $1 million plus $600,000 that you'll see here in a second, they turned that property back over to the partnership. So that was kind of how they did it. Sometimes you hear about phase 1 and phase 2 of the project. Phase 1 was this public phase that the city did. Shockey did the work. Or sorry, not Shockey, Lance did the work and then turned it over to the developer, who then brought in Key, who's doing the work now. Here's the other sources of money. So the city stepped up in addition to the $1 million that they got from HUD to $650,000 of general funds money that just came out of their budget. The EDA is a second lien position behind the bank and to the tune of $200,000. So that's a loan that they expect to get back, but it's a low interest loan and it's subordinate to the bank. And so then there's a $1.2 million bank loan and the tax credit bridge loan. The reason you need it, and all historic tax credit projects that you syndicate credits need some sort of bridge, because you don't actually get the historic tax credits until the property is put into use, which requires a certificate of occupancy and your Part 3 approval. And so, but you need, in a lot of these projects, you need that equity to make the budget work. So you essentially have to either front it out of your own pocket or borrow it from the bank. And in this case, they borrowed it from the bank, and we get repaid our historic tax credit bridge loan when the historic tax credits come in. And so because we're the historic tax credit investor and the bridge loan provider, it reduces our risk, and we're monitoring construction, so we feel pretty good about getting paid back on the bridge loan. But it's not always easy to find a bridge loan because it is equity, and you're generally not, you don't have the value there in the property to secure it with, so you kind of have to work through that with your lender if you're syndicating historic tax credits. So just a little bit on interest rates, and then get you out of here. And this is basically how I feel. This is Uncle Sam talking to Ben Bernanke. He's saying, "Are you sure this inflation is not an 800-pound gorilla?" He said, "Relax, he's not a pound over 750." And so here's, this is kind of where we are. These charts are mostly from Wall Street Journal. The Fed has used its balance sheet to keep interest rates low for a protracted period of time in order to stimulate economic activity in the markets. Those events are typically referred to as quantitative easing. There's a number of other tools they use, but the one that gets most talked about and the one that had the biggest impact probably is quantitative easing. We've done it 3 times, and as this chart shows. And basically what quantitative easing is we create money, then we go out into the market and we buy U.S. Treasury securities and agency-backed, which Fannie and Freddie mortgage loans. And so we're taking money, essentially putting money into the market. So we're buying somebody else's treasuries that then they go out and use that money to do something else, which is the theory. And so the Fed's balance sheet went from $500 billion to now $3.5 trillion of essentially debt that it owns on its balance sheet. And so what that's done essentially is, if you look at this chart and that chart, it's remarkable how the quantitative easing pattern and the stock market run-up has mirrored each other. And the theory is, so companies are doing better, the economy's doing better, but also investors have no place to earn any return. And so, and they're flush with cash because the Fed's buying all of their treasury securities and agency securities. So they're putting it in the market because that's the only place you can earn any return, which has boosted the stock market tremendously. It's a question, and I certainly don't have the answer, of whether fundamentals are driving the increase in the stock market or if it's just there's no other place to put your money, and so it's self-perpetuating. The Treasury Note, as a result of the quantitative easing, has gone down. And we've had some blips, but generally it's gone down from 4% to 2.5%. It was like 2.30 around May, and so it's had a downward pressure on 10-year rates. 10-year rates are largely what drives mortgage rates, where you and I borrow to finance our house. So that's had a positive impact on the housing market. What you'll see there on the end, which is kind of very interesting, is that in the last 6 months, the rates have gone up by almost 1%, right? In some cases, some days over 1%. And that has nothing to do with what the Fed's doing, because they're still out there buying $85 billion worth of securities every month. It has a lot to do with whether they'll continue to do that, and if they can continue to do that. Obviously, it looks like the Fed's purchasing of securities has had a good impact on the stock market. So Fed forecast, the Fed drives everything. Right now, the Fed is in control, at least that's what we think, or we hope. The Fed has committed to keeping short-term rates at or near zero until the unemployment rate gets to 6.5%. And it's right now at 7.3%. Its own estimates show that the unemployment rate will cross the threshold of 6.5% in 2015. The Fed's target short-term rate, which is its Fed funds rate, is 4%, and that right now it's 0.25. It's at as low as it can go, and its target inflation rate is 2%, and it expects us to get there by 2016. So you can see they're expecting short-term rates to rise in the next 3 years, and inflation to remain relatively stable at 2%. Those are both that's their kind of target, but all three of those really are their target. 6.5% slightly above maximum employment, but 4 and 2% for short-term rate, and inflation is like sweet spot. So that's where they want to be, and that's what they're projecting. This is kind of shows you what people are expecting the rates to go to in April. This is where their yield curve shows. This is the shortest term rate, and that's the longest term 30-year rate. It shows you how it's bent at a certain point in time. So in April 2013, this is how the rate looked. Today, this is how the rates look, and then this is how they're expecting it to look in 2015. So everybody's looking at rates going up. That looks pretty orderly, like it's going to happen in a real simple and accommodated fashion, but that assumes that somebody's in control and that this will just happen as everybody expects it to happen. And hopefully that's how it happens. But here, some of the things that you need to be thinking about is, I think every person, including Fed thinks that interest rates are going to go up, and we have a problem with how much we own today in treasuries, and at some point we have to get out of that, which will affect rates. But the first question is, when will the Fed stop its $85 billion a month bond buying program? They've hinted at that, and that's actually kind of what happened in May of this year when rates shot up overnight. The 10-year rate went from 230 to 260 within a week because one of the Fed governors, I think it was Texas or San Francisco, kind of hinted at the fact that they were going to start slowing down their bond buying by early part of next year, and so rates shot up. But since then, they've really backpedaled and said, well, no, we're not talking about that yet. We want to see unemployment rate come down, and we're expecting long-term rates to be low for a long period of time. The Fed's meeting today and tomorrow, and they're going to come out with a statement tomorrow, and we'll see. You know, everybody parses those words very closely, so we'll just have to see what they say. And so it has control over the Fed funds rate. It can decide if it moves up or down. So when does it actually start moving rates? And most, I guess, they're saying right now that it's 2015. And I think this one's really key. Does the market really believe that the Fed, its forecasts and its statements? And you're seeing a lot of this tension between the market and the Fed, where the market's moving despite what the Fed's saying, and so you know, you've got people in the market who are basically saying, I don't believe that you're going to be able to control this when you start to unwind it, and we're selling now, which drives rates up, and the Fed's saying, no, we're serious about this, we're keeping them short for a long time. So, and then who will be the next Fed chairperson? Ben Bernanke's out, and there's talk about who the next person's going to be. I think, you know, the popular bet is that it's going to be Janet Yellen, who's the vice chair now. And most people think that that's a good idea, but we'll see. She's not a shoo-in, and the president appoints her. So I know he kind of had his favorite person, which was Larry Summers, who backed out. So we'll see. We'll see what happens. So that, I think, is it. So if anybody, I apologize, I took way too long. If anybody has any questions or anything they want to ask. No. Oh yeah, go ahead, John.
When you're looking at the performance for a project,
Yeah.
how far out do you go? 10 years, 20 years?
You go out as far as you want to hold. You're going to hold the property. So 10 years is kind of the standard. I've seen them run at 7, where you anticipate selling at 7. Because and when you do your pro forma on that kind of discounted basis, you should have a year in which you sell the property, because then you discount that back to present value. So 7 or 10 is probably is a good number.
What escalation factor would you expect to see right now?
I mean, 3 is what I see on most of them, and whether that's accurate, I don't know. 3 is standard.
Go ahead.
I have a few questions. On the Taylor Hotel,
Yeah.
you'd mentioned that the apartments, you get your COs this year, but you seem to hedge your bet on the commercial aspect of it. How's that going to affect your tax credits?
All we need is a partial or temporary CO to get the credits. So we just need something to be able to be occupied in order to get the credits. And so that's the goal. The commercial thing, the shell will be done, but the tenant's not going to be in there. And so you'll have a shell, you're part of a shell occupancy permit, but not the build out.
So the build out you won't get tax credits on?
They're going to miss that. And it's actually really nothing in the budget. Phase 1 assumed that the tenant was going to do all their build out.
The numbers that you mentioned for syndicating the tax credits, I think you said it's like 96% or 96 cents on the dollar for one and 80 some on the other. It seemed awfully high compared to the numbers I've seen. Is there something with that project that's driving that up? Is it because it's a high profile project?
I don't think, I mean, the state tax credit investor is Delta Dental, and so I don't think they care about whether they get, I mean, obviously they're not publicizing themselves as the state tax credit investor, so I don't think there's anything having to do with that. And we both know the syndicator, Wishnef, and there wasn't anything out of the ordinary for what he was getting on the state credits from Delta. The federal credits, we felt like we were paying a little bit too much, But when you bake in the preferred return, which is $110,000 over the course of and our last bit of money doesn't actually go in until the 5th year. We're actually paying about 85 cents on the dollar. But we also, it's sort of all negotiated. We negotiated how much we were paying for the credits, how much we were getting on the loan, that kind of stuff. So it might be a little bit high.
Last question, the development fee
Yeah.
that you mentioned, I know, that's what, 20%?
Yes.
What does that cover, or, I mean, what is there a description of that, or is it just development fee, 20%, take it or leave it?
That's it. I mean, most folks, including us, aren't gonna let you just take it at closing. We bake it into the budget, but then you contribute it as equity. In some cases, we'll allow you to earn part of that development fee during the course of construction. Essentially, it's just a way to get more tax credits. If you got a ton of equity in the project anyway, we may let you just take that as you draw down the loan, but it's just an equity component, really, is a way to get additional credits. But you earn it. I mean, as part of the LLC with your partner, you're due that credit. It's just that's a partnership issue, and not so much the bank issue.
But that's not with DHR, they don't say you've gotta spend this much to get this 20% fee, they just, here it is.
It's a factor of how much your other costs are. Whatever your eligible project costs are times 20% is what you get as a fee. And you don't necessarily get it, but that's what you're allowed to get credits for.
Does the city, in the case of the Taylor Hotel, or any public body government, have any rational way to analyze the value of its contribution to a project like this?
Like this one?
Yeah, because there's a lot of public money.
It's a tremendous amount of public money. By far, the most the city's put into a project in Winchester. I mean, the EDA puts money in all the time, and historic tax credit money is what it is. But I think there was a tremendous outcry from a lot of folks, including PHW, to say we need to get this thing renovated. We don't want a big giant hole in our city. And if you leave it the way it is, it's just an eyesore, and it's deterring from what we're about to do, which is spend $7 million on the renovation of the Walking Mall. In this case, there wasn't a tremendous financial analysis. The city said, here's how much sales tax revenue we're going to generate from this. Here's how much the property values are going to go up. This is the center of our Walking Mall, and it's one of the most historic buildings in Winchester. We got to do something with it. Let's put our money where our mouth is on this one. But that was unique. I mean, but you could see from the numbers that there was no other way to make it work. I mean, it was that, or some people were talking about an ice skating rink. I mean, it was just not. There wasn't a lot of options. Do you have a question?
Yeah. 3 or 4 years ago, I attended a conference in Philadelphia, the American Association of Museums, which is now the American Alliance of Museums. Anyway, at that conference, they had a session on low interest. Well, they had a session on financing capital campaigns and building projects, but they talked about low interest loans that banks offer to 501c3s, and that they charge a lower interest rate because the bank is actually getting the tax write-off, because the money that is coming in is not taxed as high as it's coming from a 501c3. That's where the Children's Museum of Philadelphia funded its. Do you know anything about that?
We don't. I'm just trying to think of what. There's no benefit to us from a tax standpoint of lending money to a 501c3 just as a 501c3. I mean, so that doesn't by itself qualify us for any favorable tax treatment. The only thing I know of is when you do tax-exempt bond financing, which the industrial development authorities do here in Winchester and around, where the bank doesn't have to pay income taxes on the interest on the loan, and so you pass those. Like Shenandoah uses it for its projects, the hospital uses it for their projects, and so you can do industrial revenue bonds through an IDA. The city of Winchester has one, Frederick County has one, They have an annual capacity of $10 million that they can do tax exempt. And so basically you're still doing it through a bank, but there's a go-between the borrower and the end user are in the bank. So that's one way to do it. And that's you basically can take what a market rate of interest is times 70%, and that's what you borrow at, because the banks pay 30% or so federal income tax. So it's a tremendous boost. It might be, and there may be different states have different programs, and our EDA has a very low interest loan, which is what we've done on this and some others. So you borrow that at Treasury +1, so that's 1.5%. So there's nothing that jumps out at me just based on that, but that's one way to do it. Any other questions, thoughts, comments?
Where do you see to me these days it seems like the appraisers have very little accountability, and consequently they're bouncing all over the place, being rampant. What do you see changing in the rules and regs that the Feds have set out and the regulation powers to reel that in a little bit?
I don't hear anything about reeling in the appraisers. I mean, the government puts out these guidelines that they haven't issued one since basically like 2009, 2010 on appraisals. And it's a joint interagency, all the banking regulators and the Fed come out with these guidelines. And so that and just the sort of public backlash against them for overappraising stuff pushed them towards being more conservative. They haven't really changed their methodology, it's just their conclusions have changed in terms of, it's all, as you've seen them, there's a lot of estimating, like how much do you discount this, or how much vacancy should I put? They just have inflated those, they've inflated their vacancy or reduced their rental rates or increased their cap rates, and so I don't see a tremendous amount of change within their methodology. I feel like just within the past 6 months or so, I haven't seen a lot of appraisals that have just totally blown up deals, which is what we saw for a long time. My hope is that just like the banking sector, it gets back to normal. That's my
I've seen cases where there are very specific examples of where they are, not necessarily just by changing the cap rate,
Really?
but they might have historical, 5-year historical rental rates that have been continuous, even with renewals in commercial leasing, and they say, well, that's not where the market is, even though, and we're going to run into this with downtown. I mean, with the PAT study that the city's doing right now, showing how many top-end apartments.
Yeah.
It's easy for an appraiser to say, well, that's too expensive, so instead of that being a $1,200 unit, we're going to write that down to $1,000, so automatically they've decreased, the income side of it and screwed up with the appraisal right there. And the recourse for fighting that stuff is nil.
Very little. I agree. Once they put it on paper, it's like it's gospel. You can't change it. But I fight it all the time. I've fought it less recently, but I have fought that battle. There is little recourse other than the bank deciding that we should take them off our list. I mean, we all have our list of approved appraisers, but that's about it.
You spent $5,000 on the appraisal, so.
Yeah.
I mean, does the bank have the authority to disregard that without the regulators chewing you all up? And just say, hey, or you go instead of from 70% or 75%, you say, I'm going to loan 80%.
Yeah, you can do that. I mean, 80% is really the max. And so if you're coming in lower, then you could say, well, we're going to go up a little bit. But there's not, you get second guessed if you go out and get another appraisal, just because you didn't like the conclusions. Now, I've had some success articulating why we disagree and having them make some modifications, but getting that second appraisal really it's a stretch. I haven't seen it done hardly at all, because it does raise a lot of red flags, unfortunately.
But the bank can remove an appraiser from the list.
Yeah, and we've done that. I mean, the list has gotten small. Unfortunately, I feel like the folks we use are pretty good, and I haven't had a lot of problems with it. There's been folks who still are doing appraisals in the market that we've taken off, because they're, not necessarily because they're too conservative, but because they're all over the place, or their work's shoddy.
but do the examiners then penalize you in any way if you were to change the parameters for that particular loan? Say you do go to 80%?
No, they don't, as long as you're within your regulatory guidelines, you're okay. If I decide I wanna lend you money at 70% instead of 80, that's my deal. If I wanna go from 70 to 80, that's still my deal. Now, if I wanna go from 80 to 87, then that's a regulatory issue. It's fine, I can still make you that loan, but I gotta flag it, and the regulators are gonna come in and look at it.
Over 80.
Over 80, yeah.
Which means you have to put money in your loan loss reserves at over that 80?
No, you don't put them in your loan loss reserves, you have to put them in a special bucket that allows you, there's a bucket of loans that are called high loan to value, or Reg H. And so you can only have a certain amount of Reg H loans compared to your total capital. And so once you exceeded that, then they start putting more scrutiny on you. So you just have to limit the amount of loans with that exception on it. All right, well, thank you. I appreciate your time. Hopefully I didn't bore you too much.